Hello, my friends. This is Doug Fabian. Welcome to my weekly ETF report. Today is Thursday, August 27th, 2015. Thank you for joining me today. Three things we're going to discuss: U.S. domestic equity markets, the international markets, and Monday's big drop in many exchange-traded funds intraday. Let's begin with U.S. equity markets. I've got four charts for you. First is a chart of the Dow Jones Industrial Average. You can see that the Dow and all of these indices that I'm going to show you are clearly below their 200-day average. But what's important to note is that this decline in the Dow did break last October's lows. Moving on to the SPY, the S&P 500, you can see that the SPY traded down sharply. At the lows this past week, it had corrected more than 10%. We've got an intra-week rally going on this week, but the S&P 500 did not break last October lows. Next chart is the NASDAQ 100 QQQ. It also is below its 200-day, but did not break the October lows. And then finally, small cap stocks, below their 200-day, but did not break their October lows. Now, why are the October lows important? That was the previous inflection point. And if we closed below on all four of these charts, below the October lows, that's an indication that something else is going on in the economy and maybe we're slipping into a new bear market. I don't expect that to happen, but I'm giving you an indication of what could transpire if we were rolling into a new bear market. Let's look at the international markets. First chart, EFA, large cap domestic international stocks overseas, excuse me. This is China, this is Japan, it is the UK, Europe, Australia. This has not broken the October lows, good thing. And then lastly, we have the emerging markets. The emerging markets have broken their October lows, and the emerging markets are in a bear market more than 20% below the October lows, more than 20% below their most recent highs. So there you have it. The international markets, especially the emerging markets, are in a bear market, but the developed markets and the U.S. market are in correction mode. Now let's talk about Monday's trading. And we all know that stocks went down 1,000 points in terms of the Dow on Monday morning. Stocks were down 5 to 7%, but certain stocks, Apple Computer was down 15%, GE was down more than 20%, but some exchange-traded funds fell more than 30% on the opening on Monday morning. Let me show you this chart that just shows the one-day trading action on Monday of ticker symbol DVY, the dividend ETF. This exchange-traded fund fell more than 30% in the opening minutes of trading on Monday. Now, 30% is certainly more than the market was down. Why was this ETF down so much? Let me explain a few things. First of all, the ETF is considered an individual stock, and it fell on the open more than 10%, and so the stock was halted. Those are the new rules that are in place after the flash crash. Then once the stock reopened, there was a bunch of sell orders that were all pent up to be executed once again, and DVY fell another 10%, and it was halted again. And then it happened a third time. And so DVY ended up being down 30% in the opening 15 minutes of trading because of a huge volume of sell orders. Then the opposite happened. People saw value, they wanted to buy DVY. So it started to go up more than 10%. It was halted again. Up 10% again. It was halted again. And so DVY started, getting back on track, and it ended up closing at the normal place it should close, down about 3% on the day Monday. So there were some problems with ETF trading in the early hours of Monday. There were problems at TD Ameritrade, there were problems at Scottrade, there were problems with hundreds of exchange-traded funds like this. So what can we learn from this? Number one, as I have told you many times, never trade the first hour. If you can avoid it, don't buy and sell on the first hour, and many people just panicked and they should not have sold their security. Second, market order stops. It is now my recommendation not to carry market order stop losses on your accounts. And I want you to use limit orders if you're going to use stops. I'm going to discuss this in much more detail in the next issue of Successful Investing. But we've got to change the way that we go about investing when we now experience this kind of fast-moving market. Now, with Successful Investing, we really haven't had much exposure to the stock market because we have sells in effect for both domestic and international. But for a lot of people who are operating on their own and not subscribing to Successful Investing, you could have gotten hurt in Monday's trading. If you did, I'd like to hear your experience. So send me an email at askdoug@dougfabian.com. And if you're not subscribing to Successful Investing, I would encourage you to take a trial subscription, because I believe right now we're in a high cash position, but we've got some great buying opportunities on the horizon as long as we don't slip into a new bear market. This is Doug Fabian. Thanks so much for joining me today.